Good evening and welcome to the Friday Symposium. Today is the 21st of November, but this broadcast is being pre-recorded just in case anything has broken in the last few hours that we don't mention. I have joining me shortly Paul Gallagher of the editorial team of Executive Intelligence Review, an economist, a longtime associate of Lyndon LaRouche, and we're going to be talking about a very urgent mobilization to get the United States to move toward LaRouche's four laws, starting with the reinstatement of the Glass-Steagall Act. But before I get to that, I just wanted to point out a couple of things. One is on Thursday, yesterday, there was a very important webcast organized as part of the expanded Executive Intelligence Review platform. This topic was Venezuela, Trump, don't do it, with experts introduced, of course, with Helga Zepp-LaRouche, Dennis Small of the Ibero-America desk of Executive Intelligence Review, President Ramotar, the former president of Guyana, Ray McGovern of the Veteran Intelligence Professionals for Sanity, other journalists and people from Ibero-America, including an important television personality and labor organizer from both Venezuela and Brazil. And I think the discussion was extremely worthwhile, and I would like to encourage people to watch it. I also want to say something about the domestic situation in the United States, which I think is wide open, and we have a real crisis. The party lines no longer mean anything. That was seen in the election of Zoran Mamdani in New York. And my point is not that Zoran Mamdani particularly is a great genius or has a brilliant program. He's met with President Trump at the White House earlier today. But the Zionist lobby, the AIPAC lobby, failed to carry the day. Similarly, Trump has foolishly decided to start attacking one of his most loyal supporters, Marjorie Taylor Greene, the congresswoman from Georgia, who refused to back down on releasing the Epstein files. And of course, the Congress voted overwhelmingly, 427-1, to release them. Trump had to cave and order or encourage all the Republicans to vote to release them, I think mostly to hide the fact that he has lost control of his party, and that it would have been a terrible defeat if he kept insisting that the Republicans should vote to not release them. And then you had most recently a really despicable 1.5-minute video produced by 2 senators and 4 congressmen, all of the Democratic Party, but more significantly than their party is their military and intelligence backgrounds, led by Alyssa Slotnick, who is a former CIA agent, Mark Kelly, formerly in the with the U.S. Navy, and those are the 2 senators. And then from the House of Representatives, Jacob Crow from Pennsylvania, I believe, Chris DeLuzio, Maggie, whatever her name is, she's married to Jake Sullivan, and Chrissy Houlihan, all of them have military backgrounds, and all of them, with the exception of Chrissy Houlihan, who was in the Air Force prior to the Desert Storm operation, the horrific illegal invasion of Iraq, when everyone knew they didn't have weapons of mass destruction, and certainly these people did. Elise Slotnick was in the CIA in Baghdad during Desert Storm. I think she started just after the war began in 2004. advising, quote unquote, advising and briefing the U.S. ambassador to Iraq. This is a war in which we killed 1 million Iraqis, 5,000 plus American servicemen were killed, another 5,000 U.S. contractors were killed, or thereabouts is what I have seen. 22 soldiers are now committing suicide per day in the United States as a result of this, and none of these Democratic representatives did what they were urging the U.S. military and intelligence active duty people to do today, which is to disobey orders which they find unconstitutional. Now, of course, the military is sworn to uphold the Constitution. And if it is you're asked to do something against the Constitution, it should be against your conscience, and you might quit. You might get a dishonorable discharge. But for members of the Congress to encourage the military to go outside of the chain of command when the members of the Congress are the lawmakers who determine what the military does, it is the obligation of the Congress to protect the military and see that they are not deployed illegally. And these people all went along with the Iraq war. So it shows they're a total fraud, and they're just trying to create a chaotic, difficult situation. Now, unfortunately, Trump, who is reeling from his loss of support, reacted by not only saying that this was a seditious act, which in my opinion it was, but to go on to say that the penalty for sedition is death. So now there is a huge uproar about this. It's really, I think, creates a very unstable situation. And I think the focus should be on these people who are trying to undermine the ability of our government to function and who are not upholding their duties as members of the Senate and the House of Representatives to use the power of the Constitution to organize their fellow representatives to get our nation off of this path for permanent war. And these people have not been outspoken against the genocide in Gaza, by the way, and I don't believe any of them has been particularly outspoken about arming Ukraine. So the whole thing is a complete fraud. But I wanted to say that because I know Americans are getting pulled into all of this in a very emotionally intense way and not looking at what's behind it. And what is behind all of this is the end of the British Empire and the looming blowout of the financial system. So I'm going to bring Paul in right now. Hi, Paul. I'm glad you're here.
Hi, Diane.
And what we wanted to do is go through a document that Paul has prepared for activists around the country to understand what we mean by reinstating Glass-Steagall, why this has to happen, a little bit of the background. And Paul, you should say whatever you want to say about this mobilization, and I can pull up the graphic whenever you're ready.
Well, let's start. Go ahead. Bring it up.
Is that large enough?
Just barely. A little larger would be better, but
let's see here.
You'll do.
Let's see. Oh my goodness. Can you still see that on the screen?
Yes, it's still on the screen.
Okay, so
if you move it gradually as I go along. This is a chart that I made that I've used before, but it's invaluable in understanding that the current state of the U.S. banking system, where a large portion of the deposits, even of ordinary banks, are used for various kinds of speculation, mortgage-backed securities, derivatives, real estate speculation, and so on. That, rather than lending, that is not the way things have been for a very long time at all. If you move this up a little bit, Diane, it will show that this is a phenomenon of the abolition of Glass-Steagall in the repeal of it in 1999, followed by the crash in 2007 and 2008, that until that time, the ratio of loans to deposits in the U.S. banking system as a whole was essentially 100%. But after that time, in those 2 decade and a half periods chosen there above, December 2016, December 2021, the loan to deposit ratio of the banking system as a whole fell in 2 plunges to about 60%. That is, 40% of the deposits were being used to back speculation and not being loaned to anybody for anything, even leaving aside whether any of these loans were productive or not, simply weren't being loaned. Now, this is for the banking system as a whole. For the 6 biggest so-called Wall Street banks, although a number of them have moved off Wall Street, but for the 6 biggest banks, this ratio has dropped from about 85%, that is loans to deposits, down to 40%, roughly,
Wow.
loans to deposits now.
Could you just, I want to stop you for a second because I want you to repeat what you said about what that money is being used for, because someone might say, well, isn't it good that they're not lending that much money because that means the banks are more solvent. So please explain again why this is not good. What is happening with the other?
It means that of the biggest banks, that is the banks that always get bailed out by the Federal Reserve and the FDIC, only 40% of their deposit base is used for lending, and 60% of it is used for speculation. Now, what does that mean? Typically, each of the biggest 6 banks have several thousand divisions within the bank, many of which are completely unobserved, unregulated, special purpose vehicles and similar securities vehicles to which the bank is allocating money for speculation and money for investment in derivatives bets on those divisions, on those trading desks, and so forth. This is the kind of speculation which drives inflation in the economy, which drives over-indebtedness in the economy, unpayable indebtedness. That's accounting for 60% of what the biggest banks do with their deposits. And that deposit base, in their case, is 50% bigger than it was before the crash in 2007, 2008. So the deposits have grown by 50%, and the portion of them used for speculation has grown to 60% in turn. Now, if we could go down and beyond that in the memo, I've just explained what's below that chart. But secondly, in this memo, what else does Glass-Steagall does? First of all, it forbids exactly what you saw in the chart. Glass-Steagall prohibits lending for the purpose of supporting securities broker dealing. It prohibits the ownership by banks, commercial banks, of securities broker dealing or broker dealers. So commercial banks, no matter how large, under a Glass-Steagall Act being enforced, will be limited to the business of depository services and lending, and otherwise just services incidental to that, such as currency exchange or buying and selling, buying and redeeming for customers, government securities, not for their own account, but for customers' accounts. They'll be prohibited from owning or lending to funds for the purpose of securities broker dealing and from dealing in the markets for financial derivatives contracts. What I've called holding companies here is the provision of Glass-Steagall, in which commercial bank holding companies which own commercial banks will be prohibited from also owning investment banks or from owning commodities dealers, which in turn hold and speculate in primary commodities, metals, for example, which are essential to the economy. And that includes energy commodities and electricity. And then what I've called here rebuilding.
Wait. Can you go back on holding companies? Could you give examples of what is a holding company?
The holding company of a large bank, commercial bank, or what they call a universal bank, which combines commercial banking and private equity funding and investment banking and so forth, so-called all under one roof. The holding company is essentially the holder of the stock, the capital base of each of those companies, each of those banks or non-banks, as the case may be, banks or funds. Their shares, their capital shares are held by a common holding company, which is known to the public as J.P. Morgan Chase Bank, for example, which owns not only many divisions, but owns a number of investment banks, owns quite a number of different funds, probably in the order of several hundred hedge funds. Each of these banks owns hundreds of hedge funds for which it serves as the primary broker-dealer for those hedge funds. It also will tend to own money market mutual funds and other super speculating entities. They'll all be under the holding company of a bank like J.P. Morgan Chase.
Is Goldman Sachs a holding company now? What is that?
It is now, because Goldman Sachs, which is in fact nothing but an investment bank, was allowed during the 2008 crash, when it was being bailed out, it was allowed to purchase some small commercial banks, which enabled it to be bailed out, because it was still on the books that the FDIC and Federal Reserve could not bail out a pure investment bank. So they had to make Morgan Stanley and Goldman Sachs into universal banks by letting them buy, I would almost say, token commercial banks.
I remember, because one of my colleagues called them up after they were made into a so-called bank and asked if she could open an account. And they said only if you had, I forget what, $1 million, or I mean, it was some crazy thing.
Call us back later, yeah.
Right.
When you are a millionaire.
Right. Okay, thank you very much. Should we go on?
Under the last point, building the real economy, this I'm explaining here that this dismal ratio of loans to deposits is very much connected to the Federal Reserve Bank, because the Federal Reserve is a central bank which does not lend to anyone other than the biggest dozen or 20 banks in the entire banking system, into which it pumps deposits by buying securities from those banks, and as I said, it has made them 50% larger since the time of the 2008 crash. And these banks, in turn, use the deposits to speculate rather than lend. So you have a central bank which lends to no one except an elite group of very, very large mega banks. And those banks, in turn, use 60% of the deposits that result for speculation. So that means that if we reinstate the Glass-Steagall Act from 1933, which was in force until the 1980s, finally repealed in 1999, if we reinstate that, it dries out that mass of speculative debt bubbles which dominate those banks. And it sets the stage for a real economic recovery in the U.S. economy. The economy needs credit. It needs credit for infrastructure. It needs credit for industrialization. You can look at the frenzied efforts that the Trump administration is making to get other countries to somehow invest and reindustrialize the United States under trade agreements. Most of these are promises which are very unlikely to be fulfilled. But what we actually need is not investments from abroad, but a national lending bank, a national bank resulting from the nationalization of the Federal Reserve and the change of its charter to make it into a lending bank for industry and infrastructure, and also allow it to participate internationally in projects in developing countries in particular. So that's a Hamiltonian bank, Hamiltonian National Bank. It's capable of lending trillions in the United States case productively, and created by nationalizing the Federal Reserve. So that brings it back, I think, to the fundamental problem which we see in the fact that our banks speculate more than they lend.
Right.
There's no more to that.
Okay. Let me come back here. Okay. Good. So why is this worth talking about at this time? I think we see already this is really alarming that the 6 biggest banks have 60% of their money sloshing around in speculative ventures. But maybe you could say something about what's happening with the real U.S. economy and the world economy.
Well, I think, in the United States, Americans have an economy which about half of them can't afford. In Europe, it's even worse than that in Germany in particular, because it also has formally a leading economy, which its citizens can no longer afford. The United States has definitely moved far in that direction already. If you are an American household and your earnings are less than $80,000 a year, approximately, it means that you can't afford shelter, neither housing nor rent. That is, you can't afford it on the budget that you should be using to sustain your household. You can afford it by exorbitant borrowing, subprime borrowing, but or the like. But otherwise, you can't afford it. You can't afford the price of motor vehicles, cars or trucks, and of the loan. You can't afford the interest rates on the loans to buy those cars or to lease them. You can't afford electricity increasingly. This is, for most of the country, still on the order of 5% a year increase in electricity rates. That's a lot, but it's not completely alarming. But for those states in which the data centers are being concentrated, and that's particularly Virginia, Texas, Minnesota, California, and Pennsylvania, for those states, to take Virginia as the example, electricity prices increased by 13.5% last year.
Wow.
So they are going at an entirely different pace. And that is what the so-called AI revolution and the dominant tech sector in the stock market, that's what it's based on, is electricity which will not be able to meet the needs that the tech sector are positing for it. And as it tries to meet those needs, especially with nuclear power, which takes a while to build, it's going to drive up, it is driving up electricity costs, so that 45% or so of American households can't afford that either. They can't afford health care for sure, neither the health care insurance premium nor the out-of-pocket costs of health care. And they can't afford the costs of college education for the younger members of that household. And that's only naming the sorest of the sore thumbs in terms of an economy which half of Americans can't afford, while a certain upper level of income smile at these prices and buy everything up.
I also want to interject the gap between rich and poor. You know, there's a strike of the fledgling Starbucks union, which is small and is not, it's only 12,000 members, I think, out of I don't know how many hundreds of thousands of people they employ. So they said there was a giant gap, and they referenced Japan or someone where this may be wrong, but the law stated that the CEO could not have an income greater than X times 7 or 10 or something times what the average employee's income is. So in the case of Starbucks, the income of the CEO, whose name I've happily forgotten, is 6,666 times the income of the average Starbucks employee.
That's the same guy who was going to be a liberal candidate for president a few years ago, I think.
Great.
But his campaign didn't take off for some reason. Anyway, given that Americans, Germans, most Europeans can't afford their economies, then subprime lending of various kinds is taking center stage among those very large populations. And now it's beginning to, the unpayable debt involved in subprime borrowing is beginning to bring companies down within what they call the private credit. I don't know why they call it that. It simply means non-banks or financial entities that are not banks, funds of various kinds, which in turn are borrowing large amounts from banks, which are banks. Those private entities are lending in an unregulated manner, and some of those companies, lending companies, are now going under and causing considerable volatility and problems in the financial system. Tricolor auto lending was the first of them. First Brands, which is a conglomerate of auto parts companies built up in a short period of time, cheaper auto parts companies, was a much bigger one, which also liquidated. There have been 2 or 3 more in that category, and that is consumer debt category. And now we're seeing the first of them in the logistics, in the supply chain of business. This is a company called 4840 Solutions, which is a logistics company, which is particularly sensitive to trade and trade disruptions and increased costs of trade, as for example with tariffs. It provides pallets, the kinds of pallets on which everything from small pieces of furniture to entire containers, freight containers, are transported. And there's a lot of logistics to that. It's one of the largest of the pallet logistics company, and it's now under very significant debt financial strain. So its own lenders are now all trying to help it out so that it doesn't liquidate and cost them a lot of money. But that's the first of the supply chain businesses to go into that sheep dip as well. So now on top of that, and here's where it gets really dicey, is the Treasury market, which is the largest financial, the largest debt market, the largest financial market in the world by a significant margin, including the the Treasury securities not available to the public, the ones that go into the trust funds for Social Security and Medicaid and so forth, or Medicare. Those that's a $38 trillion plus, 38.2 or $3 trillion financial market, easily the largest in the world. And to give you an idea of what's happening in that market, the Federal Reserve, as many of you know, is now maintaining a federal funds rate in the range of 3.75 to 4%. And there was tremendous anticipation and pressure on it to lower that in December to 3.5 to 3.75. Right now, it's still 3.75 to 4% federal funds rate. Well, what is the rate at which Treasury securities are being bought and sold in the overnight market now? And what is the actual federal funds rate? As of this week, it was 4.05%. So it was not, in fact, in the range that the Federal Reserve established for it more than a month ago when it cut the rate down from 4.25% down to 4%. It's above that range. That's an indication that rarely happens. It's an indication of a great deal of liquidity pressure against the Treasury market in particular, but against the debt markets in general. There isn't enough liquidity to keep circulating all of that debt, and in particular, the debt in the Treasury market. The federal funds rate, rather the overnight repurchase rate, went as high as 4.25%. That is, it went a full quarter of a percent above where it was supposed to be, above the federal funds rate, only at the end of October. So that's 3 weeks ago. And that situation has continued to be maintained right up until this week. Now, I had a guy, if I can just, this isn't something I need to show on the screen, but just something that I wanted to quote. And I'm sorry. This is a guy who is with a securities company, SMBC Nikko Securities. His name is Joseph Abate. He's the head of rates strategy at that fairly large securities company. And he said the following this week: "We suspect that markets may be more vulnerable to overnight funding rate pressure than they were in 2019. Now, in 2019, September 16th and 17th of 2019, these rates for overnight borrowing in the banking system and among all these funds, these rates went from 2% in one day to 10%. And overnight, there was a crisis which in less than 3 weeks after that, by October 4th of 2019, had led to the launching of quantitative easing 5. That is the fifth. The Federal Reserve had to step in with billions, then tens of billions, then every night hundreds of billions of dollars in liquidity in order to get the banks through that night and the next day and enable them to repay their repo loans. So when he says they're under more pressure now than they were in 2019, that's an extremely serious reading of the repurchase market, which is supported by Treasury bills. And this has been in part caused by the fact that the Trump administration, inheriting a huge and very, very rapidly growing federal debt, growing by $2 trillion every year in net debt, the Trump administration has been desperately pressuring the Federal Reserve Board of Governors and the FOMC to lower interest rates quickly. As part of that pressure, they had switched over to issuing new debt overwhelmingly in the form of Treasury bills. That is the shortest term, 30-day, 60-day, 90-day Treasury bills, issuing at one time in one quarter $565 billion worth of Treasury bills. And the proportion of the, and Treasury securities go up to 10 years, 30 years, 20-year securities, 5 years, 2 years. These are absolutely the shortest duration. And they now account for 26% of the total Treasury issuance. That's only.
Now, who buys those?
Who buys them? Primarily, again, speculators who are speculating in quick moves among very short-term interest rates, and in particular all of these hedge funds which are participating in the basis trade, as it's called, in which they're betting on the difference between the current rate right now of short-term Treasury securities they might buy and the futures of short-term securities they might buy in 90 days or 180 days. And they use these Treasury bills as security, that's collateral for all the derivatives bets that they're making. So you have a Treasury market that's devolving, it's being deranged into a highly volatile, highly speculative market, which it now appears does not have enough liquidity to keep going smoothly. And now that it looks like the Federal Reserve may not lower interest rates in December, the pressure is becoming excruciating on the liquidity within the Treasury market, and that affects the liquidity within the broader lending markets, including all these debt lending to people who can't afford to repay the loans. It should remind you of when housing got completely out of control and out of the range of what Americans could afford in the first 6-7 years of this century. And so subprime lenders and securitizers of subprime loans took over to try to make those American households think that they could afford those houses. And the result was a crash. Something very much like that is happening right now. We don't know if we're in 2004 or 5 or 2006, how close we are, but it's this unaffordability, this proliferation of debt, which households and businesses cannot in fact repay, ever, have no hope of repaying really. That's what is leading to this extreme pressure of not just volatility, but the lack of liquidity in the market, and in the biggest market in the world, it's showing itself in the most dangerous form.
I guess the 50-year mortgage plan is part of this.
Yeah,
That's Trump's plan to lower the price of, he's not going to lower the price of housing. He's just going to stretch it out so the bank gets more money and the person gets less house while
right.
they're alive.
Person eventually pays more for the mortgage, but doesn't pay it off.
Right, exactly.
Which is the way things were in the 1920s, when people had unpayable mortgages that they could pay as they went all along for as long as 10 years. But then they came to a balloon payment at the end, which involved the majority of the principal. They absolutely couldn't make that payment, and so they'd lose in most cases, their farmhouse and their farm. So that's why we've got to, now, this immediately then demands, I think, two things really simultaneously. One is that Glass-Steagall be reinstated. And again, in the major European economies, this situation of debt and affordability is worse. It's significantly worse than it is here. So when we discuss here, we're discussing global in a sense. That the first thing to do is to reinstate Glass-Steagall so that the banks have a decent period, say it's 6 months, for all of these thousands of, or in the regional bank case, hundreds of little speculative divisions that they have to sell them off. They have to get rid of them one way or another. And in the process, because they are not allowed under Glass-Steagall to hold or lend to speculative funds of that kind. So in the process, most of those speculative entities will probably go bankrupt, and they will have been barred from being bailed out by federal agencies, by taxpayer funds in any way, by the FDIC, Federal Reserve, or any other agency. So they will probably go bankrupt, and that will dry out speculative markets to a significant degree. Now, if that's all we do, then we have a recession. We're going to have that anyway, but we have perhaps a deeper recession if that's all we do. But it isn't all we do. We create a national bank. The easiest way is by nationalizing the Federal Reserve and creating a national Hamiltonian lending bank in the New York Federal Reserve Bank, which has the capacity to put trillions of dollars over a period of time in credit, in new credit, into reindustrialization and infrastructure, both here and where it's most needed and most profitable too, in developing countries abroad. So we do both of those things, and we replace the unpayable debt that's dried out and lost with eminently repayable credit, because the productivity involved in the projects and in the reindustrialization makes those debts of that credit more than payable. So that's what I think we need to do. We must do it. We don't, as I say, we don't know how long this economy is going to limp along, but as the problems in unpayable debt for the household and business in the country become worse, the certainty of a crash also becomes, or the likelihood of a crash also becomes more certain, for the absolute lack of support for all of that speculative debt.
All right. Now, what do you say to those people who say, well, you can't do that because that will bring down my stock value and all these other things?
Well, it will, but you have time to you have time to change what your 401k is invested in. Yeah, the Glass-Steagall Act is going to typically give the big banks 6 months, perhaps a year, but more likely 6 months, in order to separate themselves from all of these speculative entities, which a lot of which will then be going under. So you have time, get out of them.
And also, I mean, as you say, this is, if it's simultaneous with the national bank that is issuing credit for things that are actually productive and will increase the productive power of the workforce and the productivity overall, then you could see that also, I think an effect would be the purchasing power of your income would increase so that you would have a more stable and reasonable standard of living. Would it not?
It would. And while that was happening, there also would undoubtedly be federal government support, and also state government support for the financial arrangements through which people are getting pensions, or in this case, nowadays, much more getting 401ks and related retirement accounts. Those would have to be supported, and they would be supported. So.
Well, I think this, part of the challenge I think we have is to get people to separate their thinking about economy from their thinking about money or markets and physics instead. Lyndon LaRouche used to say, money is an idiot, money is an idiot. And that's tough nowadays. People are so removed from the process of production. I had a conversation with someone the other day who told me he loved President Trump's tariff policies because the tariff policies were what was making it possible for him to not pay taxes on his overtime pay, and that this was going to give everyone $2,000. And I said, but what if all the farmers go under? What if there are no more farmers after this? And that it was a disconnect. It had not even occurred to him that there was a relationship between this kind of policy and what happens with whether we have food, or whether we can fix the bridges, or whether the food can actually get to the grocery store, or whether you have electricity there for refrigeration.
It's the difference between money and credit. If people can count their money, if they want, if they will, and obviously everyone does at some time. But credit is something different. Credit is is actually a future. It's the representation of a future higher productivity and greater production, real production, in anything from a household to a business to the economy as a whole. Credit is always extended in order to create a future situation in which it can be easily repaid. That's the way Alexander Hamilton put it, that a national debt is a national blessing, or can be, provided that the means for its extinguishment in the future are established. And that is what credit does. It establishes the means of producing more with the same amount of effort by the same amount of people, using a greater amount of machinery, using more efficient and better technological methods, so that more can be produced with a given amount of effort in the future than at the present. And that means that more is available to repay that credit than was borrowed in the first place. Now that's credit. That really is extraordinarily different from money.
Right.
which is simply a accounting unit.
Right. Exactly. Well, any closing words of wisdom or thoughts on this?
Well, I think my closing words would simply be that would be to call on citizens in the United States to show more wisdom in the way they are dealing with the current situation, and in particular, not to be running hither and yon in order to quote unquote take a position for and against leading politicians. It's like there are only a few trees out there and there's no grass. I mean, the citizens have to become the grass which grows up and supports the rest of the biosphere. In that case, they have to be capable in themselves and not simply looking up at a few trees and deciding which one of those guys or gals is your favorite. You have to know what it is to grow, what it is to make the economy grow. That kind of wisdom we should all hope for, because one way or another, we're all going to have to have recourse to it in order to get out of where we are.
I think that's very well said and really excellent advice. And that is part of why we want to start this mobilization, so that you yourself, the citizen, can go and talk to your city council members and your state legislators and your trade union friends and your Rotary clubs and tell people the truth about the catastrophe that is looming and how it could be solved. And we would find ourselves doing very much better on the other side of it, not to mention also creating a future for younger generations where they would be capable of owning a house, raising a family, paying for education, and having an education which would be sane as opposed to what passes for education today. So, Paul, I want to thank you very much for joining me, and I'm sure we'll be in touch a lot more.
Yes, hopefully this mobilization will get going, and we will.
Great. Thank you.